Have you ever wondered why a person who is intelligent and disciplined in everyday life can become frighteningly irrational when facing a losing trade? A person may spend months studying charts, years learning strategy, yet within just a few minutes of price moving against them, all logic suddenly collapses. They don't cut the loss. They add more, then more. Not because they are stupid, but because in that moment, they are no longer trading with strategy. They are reacting with the most ancient survival instinct of human nature. The market, ultimately, is not merely a place where money moves from one pocket to another. It is a magnifying mirror, reflecting every deeply buried weakness inside each individual: greed, fear, ego, denial, and the desperate need to be right. When a trade moves against your position, what is truly being threatened is not just your account. It is your belief about yourself. Maybe I'm not wrong yet. Just a little more. It will come back. And so, instead of accepting a small cut, people begin inflicting a fatal wound upon themselves simply to protect the feeling that they are still in control. That is the most painful paradox in trading. Human beings are willing to lose a great deal of money just to avoid admitting they were wrong too soon. Our brains were designed to avoid pain, not to maximize probability. So to the primitive brain, cutting a loss feels like admitting defeat, while averaging down creates a psychological painkiller. I haven't lost yet. I'm just improving my position. But the market does not reward self-comfort. The market only responds to truth. And the truth is, most traders blow their accounts not because they lack knowledge. They lose because they cannot overcome the self-defense mechanisms within their own minds. There are battles out there that require defeating the market. But in trading, the first battle is always defeating yourself. The inexperienced look at charts to find money. The mature look at charts to understand themselves. Because in the end, trading has never merely been a game of charts. It is a silent confrontation between discipline and instinct, between awareness and emotion, between the most rational version of yourself and the primitive, fearful part still living inside you. And the market, like a cold and impartial judge, always rewards those who can control themselves before attempting to control money. And then, as the battle with ego begins to reveal itself, an even deeper mechanism quietly steps forward to control every decision a trader makes: the fear of loss. It is no coincidence that losing $100 hurts you far more than the joy of making $100. The human brain, shaped by thousands of years of survival through hunger, danger, and scarcity, was programmed to perceive loss as a far greater threat than reward. In the past, losing food could mean death. Today, losing money on a chart won't kill you, but your brain still reacts as if your survival is under threat. That is why, when the market moves against you, your heart beats faster, your palms tighten, and your mind no longer analyzes as clearly as it did when you entered the trade. You are no longer looking at the chart like a trader. You are looking at it like a human being trying to protect yourself from pain. This is the most subtle trap of all. People do not hate losses because of money. People hate the feeling of loss that losing creates. And to avoid that feeling, the brain begins manufacturing incredibly convincing stories. Price just needs a small pullback. One more entry will lower my average cost. If I haven't closed it, I haven't lost. Sound familiar? The truth is, in that moment, most traders are no longer trying to make money. They are simply trying to escape the pain of admitting they were wrong. That is why so many people hold losing trades for far too long, yet take profits far too quickly. They cut off joy to protect safety, and they hold on to pain because they hope for a miracle. Irrational, yet profoundly human. One bitter paradox in trading is this: people often let losses run like a prayer, while closing profits quickly like a reflex of fear. Because the brain is always whispering, take the profit before it disappears. Hold the loss, maybe it will come back. And so the account is gradually eroded, not because the market is too cruel, but because the nervous system prioritizes short-term pain relief over long-term survival. A mature trader understands this. Small losses are not dangerous. What is dangerous is allowing the fear of loss to control your decisions. The market has never required you to be right all the time. It only requires you to be rational enough to be wrong in ways that are less fatal. To survive, you must learn to do what feels unnatural. Accept a small, intentional pain to avoid a far greater disaster created by emotion. Because sometimes, the most painful click of the cut loss button is actually the most mature act a trader can make. But then, beyond the fear of losing money, there is another force, even stronger, quieter, and far more dangerous. It is the need to be right. At first glance, it seems harmless. Who doesn't want to be right? Who doesn't want their decisions to be validated by the market? But this is exactly where trading begins to move beyond money and strike directly at the ego. Because for most traders, a losing trade is rarely just a financial loss. Subconsciously, it becomes a judgment. My analysis was wrong. I'm not good enough. I lost. And to the ego, that feeling can sometimes hurt more than the money itself. So the brain activates an ancient mechanism, self-image protection. Instead of seeing the market for what it is, traders begin seeing it through the lens of justification. It's not that the trend is broken. It's just a liquidity sweep. It's not that I was wrong. It's market makers manipulating. It's not that the entry was bad. It's the market just hasn't moved at the right time yet. Sound familiar? Human beings possess a remarkable ability, distorting reality simply to protect old beliefs. In psychology, this is called cognitive dissonance, the mental discomfort that arises when reality collides with what we want to believe. And to reduce that discomfort, most people do not change their beliefs. They bend their interpretation of reality. That is why many traders do not add to a position because the setup improved. They add because they are trying to save a threatened version of themselves. They are not averaging down for the market. They are averaging down for the ego. This is where it gets deepest. Many people enter trading believing they are fighting to make money. But in reality, they are fighting to protect an identity. I am someone who can read the market correctly. I can't possibly be wrong this easily. And that very need transforms a small mistake into a massive disaster. Because the market does not care how intelligent you are. It does not reward stubbornness. It does not pay for pride. The market simply moves. A mature trader is someone strong enough to separate themselves from their trades. A bad trade does not mean you are worthless. Cutting a loss does not mean you failed. Changing your perspective does not mean you are weak. Sometimes, true wisdom does not lie in defending your opinion to the end. It lies in the ability to let go of an opinion when the data has changed. The inexperienced try to prove themselves right to the market. The professional simply asks, what is this new information telling me? Because in trading, the bigger the ego, the smaller the account often becomes. And the moment you no longer need to be right all the time. Maybe the exact moment you begin trading like someone truly mature. But when a trader has already moved beyond the fear of losing money, beyond even the need to be right, there is still another, more subtle trap waiting ahead. It is the illusion that, this time, it has to reverse. It sounds reasonable. Price has fallen too far. There have been too many red candles. The market is oversold. The brain begins whispering, it can't keep dropping forever. And so, the trader adds another position, not because the signal is clearer, but because of hope. This is the exact moment when a person leaves probability-based thinking and steps into the psychology of a gambler. A person walking into a casino after a long losing streak often believes, I've been unlucky long enough, now it has to turn. But the roulette wheel, does not care about the past. Trading is no different. The market does not owe you a reversal simply because you have suffered long enough. This mistake is called gambler's fallacy. The brain becomes obsessed with imaginary balance, always wanting to believe that after a series of wrong outcomes, a right one must come next. But the market does not operate on emotional fairness. It operates on capital flow, probability, and real momentum. A strong trend can continue far longer than your account can survive. And what is the most painful part? It is not losing the first trade. It is continuously injecting more false belief into a reality that is moving against you. Each time you add another trade, dopamine releases a little more hope, like buying another lottery ticket for the belief that rescue is coming. Hope, in trading, can sometimes be more dangerous than fear, because fear makes you run. Blind hope keeps you inside a burning house. Some traders do not die because they lack knowledge. They die because they become addicted to the feeling of just one more trade, one more chance, one more time the market should reverse. But should is one of the most expensive words in finance. The market does not do what it should do. It does what it is doing. The inexperienced trade based on what they hope. The mature trade based on what is actually happening. The difference seems small, but it determines the lifespan of an account. One of the cruelest lessons is this: the farther price goes, the more the ego wants revenge. The more revenge it wants, the more the brain becomes addicted to hope. The more hope takes over, the farther decisions drift from logic. And then the account does not collapse from one trade. It collapses from a long series of self-persuasion. Professional traders understand this. No one gets rich trying to catch a falling knife simply because they think it has fallen enough. Sometimes, the greatest strength is not in daring to add more. It is in being clear-headed enough to admit, maybe I'm trying to turn hope into a strategy. Because in trading, the market does not punish those who lack hope. It punishes those who confuse hope with probability. But then, after all of it, after the trader has feared losing money, feared being wrong, hoped the market would turn back, they step into a trap even more dangerous than all three combined. This is when people begin to believe, I've already lost too much to stop now. Sound familiar? If I cut now, it would all be for nothing. I'm already this deep. Just hold a little longer. I've endured this far already. Quitting now would mean losing for real. And so, it is not the market that keeps them trapped. It is the past. This is sunk cost fallacy, one of the cruelest psychological traps the brain can create. Human beings tend to continue a bad decision simply because they have already invested too much into it. Too much money, too much time, too much emotion, too much hope. The problem is, the brain does not want to accept that what is already lost is truly gone. It wants to salvage it, not because the future is still rational, but because the past is too painful to let go. That is why traders often hold their worst trades the longest, not because they are worth holding, but because they hurt too much to close. A smart investor asks, from this moment forward, is the probability still valid? An emotional trader asks, after everything I've already put into this, can I really walk away? They sound similar, but one looks toward the future. The other is chained to the past. This is where many accounts die slowly, not in one explosion, but by bleeding out little by little, through decisions that keep trying to save something that should have been ended much earlier. Remember this, the market does not care how long you have endured. A trade that has been negative for 1 week does not deserve recovery more than one that has been negative for 1 hour. Charts have no mercy. They do not reward blind persistence. Many traders confuse conviction with stubbornness. Conviction is committing to a probability-based system. Stubbornness is clinging to a mistake simply because you have already paid for it. That difference can sometimes be the line between survival and disappearance. Some people hold on to a rotten branch in a flood simply because they've clung to it for too long to let go. But sometimes letting go is exactly how you survive. Trading is the same. Cutting a loss does not mean denying your past effort. It is the act of protecting the capital you still have left for the future. The inexperienced try to win back the past. The mature protect their right to continue the game. Because the deeper truth is this: money already lost does not determine your next move. Only the quality of your current decision does. Traders do not go bankrupt simply because they entered a bad trade. They go bankrupt when they turn an initial mistake into an emotional mission. And sometimes the highest expression of financial wisdom is not knowing when to hold on. It is having the courage to end what is no longer worth holding. But there is an even more ironic truth. Many traders do not lose only because of themselves. They also lose because they unconsciously borrow false beliefs from the crowd. Human beings, by survival instinct, have always had a tendency to seek safety in numbers. In the past, staying with the tribe helped our ancestors avoid predators. Being separated from the group could mean death, and thousands of years later, that mechanism remains deeply wired into the brain. The only difference is that now, the tribe is no longer a primitive clan. It is trading groups, forums, Telegram, Facebook comments, places where thousands of people share the same belief, the same trade, the same expectation. Gold is at the bottom, all in. EU can't drop any further. Whales are just stop hunting, hold strong. Sound familiar? When hundreds of people all say the same thing, the brain begins to perceive it as probably true. Not necessarily because the logic is stronger, but because numbers create the feeling of safety. This is social proof. One of the biases that causes people to confuse "many people believe it" with "it is true." But financial markets are extraordinarily ruthless. The crowd is usually not wrong because they are stupid. They are wrong because they react the same way. They fear at the same time. They become greedy at the same time. They hope at the same time. And when collective emotion reaches its peak, liquidity for larger capital appears. That is why the market often moves most painfully, where the greatest number of people feel safe. And what is even more dangerous, you rarely see the full picture. In communities, people showcase miraculous recoveries from near destruction. They post screenshots of blowing up backward into legend, but the thousands of accounts that disappeared before that, no one talks about them. This is survivorship bias. You only see those still standing on the battlefield and assume their strategy must work. It is like watching someone survive jumping from a plane, then concluding that parachutes are unnecessary. The truth is, the market has buried far more silent losers than vocal winners. The inexperienced seek validation from the crowd. The mature understand that the crowd often provides emotional comfort, but does not guarantee probability. Trading is one of the rare fields where going against the crowd is sometimes not rebellion, but survival. That does not mean the crowd is always wrong. But if your decision exists only because many others think so too, then you are renting out your brain. And in trading, renting out your thinking is often one of the most expensive ways to lose money. Professionals do not ask, how many people are buying? They ask, if all of them are wrong, what will it cost me? Because in the end, the market does not reward consensus. It rewards disciplined independence. So be careful. The crowd may give you the comforting feeling of companionship while being wrong. But feeling comforted has never been a risk management strategy. And sometimes the greatest step of maturity for a trader is when they become strong enough to remain silent amid the noise, stand alone in the crowd, and take full responsibility for every decision they make. But then, after passing through enough traps of loss, ego, hope, and the crowd, we are forced to reach an even deeper, colder layer. Traders are not just trading against the modern market. They are trading with a prehistoric brain. It sounds extreme, but it is true. Inside every civilized human holding a phone, analyzing charts, reading price action, there still exists a survival operating system written hundreds of thousands of years ago. A brain designed to run from predators, not to manage drawdown. In the past, a sound in the bushes could mean a predator. Fast reaction meant survival. Today, a powerful red candle breaking through support. The brain still activates nearly the same mechanism. Heart races, muscles tighten, cortisol rises, adrenaline floods. You think you are analyzing the market, but sometimes your body is reacting as if your life is under threat. This is fight, flight, freeze. The three oldest survival responses. Fight. Add more. Hold harder. I cannot lose. Flight. Close early. Get out now. Too scary. Freeze. I don't know what to do. Whatever. And the irony is, all three of these instinctive reactions, without awareness, can destroy a trader. Because the market does not reward primitive reflexes. It rewards regulation. An antelope survives by panicking at the right moment. But a trader survives through the ability to remain calm when panic appears. This is the cruelest paradox of all. The very instincts that helped your ancestors survive in nature can cause you to lose repeatedly in the market. In the wild, quick reaction often saves your life. In trading, reacting too quickly often kills probability. That is why a mature trader is not someone without fear. They are someone who recognizes fear when it appears, but does not hand over control to it. They understand that every time price becomes highly volatile, the first thing to manage is not the trade, but the nervous system. It is no coincidence that skilled traders gradually become boring. Less excitement, less panic, less reaction, because they are slowly transferring power from the amygdala, the emotional survival brain, to the prefrontal cortex, the region of logic, strategy, and long-term decision-making. In other words, they do not try to beat the market with stronger emotions. They win by being less manipulated by instinct. The inexperienced ask, will this trade win? The experienced ask, is this psychological state causing me to react like an ancestor being hunted? That is a very different level of self-awareness, because in the end, trading is not merely a game of price patterns. It is a process of evolving against your own instincts, and perhaps one of the greatest turning points for a trader is when they realize the chart is not as dangerous as they think. What is far more dangerous is a primitive brain holding a modern trading account. But if most traders fail because they are controlled by the survival brain, then the most important question is no longer, how do I predict the market more accurately? It becomes, how do I upgrade the person making the decisions? Because at some point, you will realize, trading is no longer a game between you and the chart. It becomes a transfer of power within yourself, between reaction and thought, between instinct and system, between the part of the brain that wants immediate survival and the part mature enough to build long-term advantage. This is where professional traders begin to separate themselves, not because they are fearless, not because they are always right, and not because they possess some magical secret, but because they gradually learn how to transfer command from the emotional brain to the executive brain, from the amygdala to the prefrontal cortex. Put simply, they stop trading like someone being hunted and begin trading like a probability manager. A beginner looks at a losing trade and asks, how was I wrong? A mature trader looks at the same trade and asks, is this risk still within my plan? It sounds like only a few different words, but in reality, it is an entirely different operating system. One side uses outcomes to define self-worth. The other uses process as the foundation of survival. This is the most painful yet necessary step of growth. You must stop tying your human value to each winning or losing trade. Because if every losing trade makes you feel like a failure, you will always react emotionally. But if each trade becomes merely a data point within a probability sequence, you begin to feel freer. Professional traders understand something that most people take a very long time to truly absorb. A single trade is nearly meaningless. What matters is the system across hundreds of trades. Just like a casino does not panic because one person wins big, it only needs long-term mathematical edge. Trading is the same. A mature trader does not ask, "Will this trade save me?" They ask, "If I repeat this process 100 times, what will the result be?" That is the moment short-term emotion begins giving way to strategic thinking. And from here, boring begins to become a powerful trait. Fewer meaningless trades, less proving, less reacting, more observing, more waiting, more discipline. Because professionals understand this, more action does not necessarily mean more profit. Sometimes, the greatest value lies in what you are disciplined enough not to do. An immature warrior draws his sword because he is provoked. A seasoned warrior acts only when probability is overwhelmingly in his favor. High-level trading is the same. You no longer ask, "Where will the market go?" As often, you begin asking, "If it goes against me, will I still be okay?" That is no longer just money-making thinking. That is survival thinking. And ultimately, the greatest turning point for a trader does not lie in becoming better at reading charts. It lies in the moment they understand. If you want to make money like a professional, you must first learn how to think like someone who does not let emotion drive. But then, after a trader has finally realized how their own brain can betray them, after understanding how fear, ego, hope, the crowd, and survival instincts can silently destroy an account, a bigger question begins to emerge. I understand now, but how do I escape? Because awareness, no matter how deep, if it is not transformed into a system, will eventually remain nothing more than a beautiful realization during calm moments, only to vanish the moment the first massive candle strikes. Trading does not reward those who understand more. It rewards those who build structures strong enough to protect themselves from who they become at their weakest. In other words, you do not need to simply believe in discipline. You need to design your life so that breaking discipline becomes harder. This is the core difference. The inexperienced try to become stronger. The mature build environments where they need less strength each time. Like Odysseus in Greek mythology, knowing that the siren's song would cause him to lose control, he did not pray for stronger willpower. He tied himself to the mast before the ship entered dangerous waters. That is pre-commitment. In trading, this means set stop loss the moment you enter. Define risk before emotion appears. Write down your invalidation conditions before the market tests you. Because when emotion erupts, the best decision is often the one you already made before emotion arrived. This is not weakness. This is wisdom. You are acknowledging that the panicked version of yourself should not have full authority. An intelligent trader does not only analyze the market, they build guardrails against the most dangerous version of themselves. And then comes position sizing. Many people believe the problem lies in strategy, but in reality, position size often determines psychological quality. Risk too much, and the brain shifts into survival mode. Risk small enough, and logic still has room to function. A position that is too large does not only threaten your account, it distorts perception itself. That is why sometimes the greatest leverage is not increasing lot size. It is reducing size to the level where you can still sleep peacefully. Sleeping well is one of the most underrated psychological indicators of a trader. If a trade makes you constantly check your phone, race your heart, and lose focus, then you are probably not trading. You are gambling with your nervous system. And finally, journaling. Do not only record entry, TP, and SL. Write down, what am I feeling when I want to move my stop loss? Am I adding because of a new setup, or because I am afraid of being wrong? Am I acting from probability or from pain? Because sometimes what needs auditing is not the chart, but the repeating emotional patterns inside you. A mature trader does not try to eliminate emotion. They build processes that make emotion less capable of sabotaging results. They understand this. You cannot stop ocean waves, but you can build a stronger ship. Trading is the same. You cannot stop instinct, fear, or greed from appearing, but you can build a system strong enough that they no longer easily steal the wheel. And perhaps the true evolution of a trader does not happen when they discover the perfect strategy. It happens when they stop betting on temporary strength and begin building sustainable structures that protect them. After all the cycles of fear, hope, ego, the crowd, instinct, and discipline, a trader eventually arrives at the most fundamental question. In the end, what truly kills a person in the market? Not volatility, not news, not whales, not even entirely bad strategy, but usually something far deeper, the need to be right. It sounds simple, but this is one of the most expensive costs in trading. Many people enter the market to make money, but unconsciously trade as if they are defending their honor. They cannot bear cutting a loss because it feels like surrender. They cannot bear staying out because it feels like missing out. They cannot bear changing their perspective because it means admitting they were once wrong. And so, instead of following truth, they follow ego. But the market is a very special place. In many other fields, a large ego can sometimes create power. But in trading, an oversized ego often only makes your tuition more expensive. The market does not reward those who defend their opinions the longest. It rewards those who adapt to truth the fastest. A dry, rigid tree may look strong until the storm comes, while the grass that knows how to bend survives. Trading is the same. There are times when the strongest action is not holding a trade, it is closing it, not proving yourself right, but preserving your right to keep playing. The inexperienced always ask, how do I win this trade? The experienced ask, how do I survive long enough for 1,000 more trades? That is the transformation from gambler to risk manager. Because the truth is, you do not need to win every battle. You simply need to avoid self-destruction in the battles that are not worth it. A mature trader understands that an account does not die from one mistake. It dies when ego turns a mistake into a personal war. At that point, the market is no longer a place for financial decisions. It becomes a battlefield where the ego demands justice. And that is when it becomes most dangerous. So perhaps the highest level of trading does not lie in some secret strategy, but in a state of mind. I do not need to be right to have value. I only need discipline to survive. When someone truly understands that, they begin to feel lighter. Lighter when cutting losses. Lighter when passing on opportunities. Lighter when saying, I was wrong this time. And paradoxically, it is precisely when they are no longer obsessed with being right that they begin making more right decisions. Because in the end, trading is not a journey of conquering the market. It is a journey of conquering the instinctive part of yourself that always wants to control what cannot be controlled. The market does not kill you. Unmanaged pride does. And the moment you stop treating every trade like a test of your personal worth, may be the exact moment you truly step through the door from being a player to becoming a trader.